Talking about everyone's favourite subject, and that is tax, something we all have to pay, unfortunately. But here to explain a few things, we have with us Tom Green, who is an accountant and managing director of family business Greenline Accountants. Welcome, Tom.
Hello there.
How are you doing?
I'm very well, thank you. Yourself?
Yes, doing okay, thank you. And Kenny, how are you?
Yes, all good. Hi, Tom. How's things?
Yeah, really good, thank you. Enjoying the sunshine.
Yep, definitely. The sun's shining in Scotland today, so it's all good. So, as Mark said in the intro, Tom, I'm particularly interested in this topic because accountants scare me, the truth be told, so they do. I don't know what it is. It's just every time I phone them, my own accountant, I'm always nervous because he's usually going to tell me some bad news. But hopefully you can.
Wow.
Yeah, I don't know. It's just I think there'll be quite a few people listening to this podcast of the exact same sort of fears as myself. But we should probably really embrace it because you guys are going to save us money, hopefully somewhere down the line. But so is that a family-run business you've got, Greenline Accountants, Tom?
Yeah, it's a family business. We've been around in one form or another for probably about 40 years now. It was started by my father back in the day. I've worked in it. My brother's worked in it. We've just recently had a little bit of a reorganisation. So we've bought a commercial insurance brokers, which my brother's now running. My father's sort of gone into, I wouldn't call it retirement. I think he'll always be working in some form or another, but he's doing a lot of consulting work and around business recovery as well. So it's sort of left the accountancy with me now to sort of push on with.
Mm-hmm. How many people do you employ? Approximately, is it quite a big business? You got a couple of branches?
We've got one branch. I've got 7 people working with us now. We're looking at possibly recruiting a couple more by the end of the year. Certainly the last sort of 3 to 4 months has really seen us push on growth wise, a little bit more so than I think we anticipated. There seems to be a lot of people, I think with COVID, a lot of people are taking the opportunity to sort of follow up on their accounts, do a little bit of shopping around, maybe looking for different accountants, and we've picked up a bit of work actually the last few months. So yeah.
Well, that's good. It's good to hear.
Yeah, absolutely.
I mean, it was a very confusing time, wasn't it, for everyone, really? There's lots of accountants have been exceptionally busy during this period.
It's been panic. It's been, every time Rishi Sunak stands up, we're on standby to put together another newsletter and getting clients. I think that's been the most important thing, is keeping the clients informed, talking to them, trying to allay the concerns, trying to make sure that they're aware of what's available for them, because ideally we wanted to be the first call. If they weren't sure of something, they could come back to us, call us, and we can try and help them through that way.
Yeah. I mean, it's strange you see that. I mean, things like the bounce back loan, obviously, that came about because of COVID. I mean, I never found out about that through my accountant. It was just word of mouth, with talking to various people that we work with. So, I mean, I assume every accountant's different. I mean, it depends how much you're paying, what kind of service you get as well. I mean, my accountant just does my books, and that's it. I don't really have that personal relationship with them, so it's just an ends to a means for me. But I'm assuming your business is based in sort of long-term relationships with your clients.
Absolutely, everything we've done historically is based on long-term relationships. We like to, we've never really marketed particularly heavily. Everything we've done has been word of mouth and referral, and all our COVID stuff that we've been doing. So things like the furlough scheme and looking after the pay-as-you-earn for clients on the furlough scheme, we've been doing free of charge because we wanted to get the clients through it. So it's a case of trying to just look after the clients and keep them a step in front, because I mean, they're having a hard enough time as it is, some of them, and we want them to have businesses to go back to.
Yeah, and obviously there's a benefit for you as well if we get businesses to go back to.
Yeah, of course.
Yeah. So everybody's favourite subject then, Tom, tax, capital gains tax.
Yeah.
What is it in layman's terms? I mean, everybody probably thinks they know what it is, but
capital gains. Yeah, of course. I mean, in its very simplest form, it's a tax that it stands separately to income tax. So if you make a capital gain, and that might be on shares or that might be on property, then at the end of the day, whatever that gain that you make is, you're going to have a tax to pay on it. So let's say, very, very simple terms, you buy some shares for £10,000, they appreciate in value and you sell them for £100,000, then effectively you've made a £90,000 gain. So at some point, the taxman's going to want a piece of that, and that's what capital gains tax is.
Okay. And what is the actual rate, or does it vary depending on your circumstances?
So with capital gains tax, what you've got different rates depending on the type of asset that's sold, and also depending on what income tax bracket you fall into. So if you, for example, are a basic rate taxpayer, then you are looking at capital gains tax on shares, then you're going to be paying 10% capital gains tax on the gain of those shares. Now, that's after you get your capital gains tax allowance, which I'll come on to in a minute. If you're a higher rate taxpayer, then on shares, for example, on a share disposal, you'll be paying 20%. So obviously, depending on where you sit in the income tax bracket, has an impact on where you sit in the capital gains tax bracket. Capital gains tax for property is slightly different. If you're selling property, the rates are 18% and 28% respectively, depending on where your income sits with income tax bands as between basic rate and higher rate. I think probably the easiest way to demonstrate it is just to work you through a very, very simple example. Somebody that's got, say, £20,000 invested in a junior AIM stock, and then looks to dispose of it at a later date.
Yeah, that makes sense, and it's relevant as well, because most of the people who will be listening to this podcast, Tom, are retail investors anyway, so it'll probably hit home.
Yep, fine. So let's take somebody then, they've got £20,000 invested in a junior AIM stock. That AIM stock performs great over, say, 1 year, 2 years, doesn't really matter, but let's say over a couple of years, that stock's performed really well, and the value's gone up to £100,000. We'll keep the figures fairly round. So you've got an £80,000 capital gain. If you've invested that through a standard investment account, then the capital gain is basically calculated by deducting the original cost of the shares from the proceeds. So the proceeds are 100,000 and the original cost was 20,000. So you've got an £80,000 gain. You then get a capital gains tax allowance, and this year that allowance is 12,300, and that's the amount of capital gains tax you are allowed to earn before you pay any capital gains tax at all. So £12,300 comes off your £80,000 gain, and that leaves you a taxable gain of £67,700. So this goes back then to what I was saying in terms of where you sit with your income tax. If you're a basic rate taxpayer, that's going to be taxed at 10%. Up to your basic rate level. But let's say you're a higher rate taxpayer, that's going to be taxed at 20%. So if you're already a high rate taxpayer because of your other income, then you're looking at a tax bill of about £13,500 on that capital gain.
And when does it become a capital gain? Is it at the point that you basically click sell, or the point you try and withdraw your money? Or
it becomes, the capital gain is effectively crystallized at the year end. So all your gains on all your trades throughout the year. So we're doing a tax year, we're going 5th of April to, we're going up to the 5th of April. So 6th of April up to 5th of April in a tax year. All the gains on your trades in that year are added up. The losses are deducted. So if you've made a bad trade, for example, then that, and there was a loss on that trade, then that can come off. And then we get a total gain figure at the year end. And that's what you're paying tax on at the year end, as at the 5th of April.
Right. So it doesn't matter that you make a gain on one and immediately reinvest it, sell it and reinvest it in another company. It's still classed as you've made a gain on the first company.
Yeah, it's if you sell it and reinvest it, you've still made the actual gain. The gain's crystallized. So it's all the gains in the year minus all the losses in the year minus your allowance, and then that's what the gains pay. That's what the tax is paid on at the year end.
Yeah. So so I can imagine this probably might get quite confusing to keep track of what you've gained and lost. How best to do that then for someone who is trading? I mean, is it their responsibility to keep track of that?
Yeah, generally it is. I mean, a lot of traders will be going through brokers anyway, so you will get consolidated tax voucher at the end of the year, which a lot of them will provide now.
Okay, and that will say what you've gained or lost.
That should give you an indication as to your capital gains tax liabilities throughout the year on there. Yeah, absolutely.
Okay.
And then if not, then obviously you can be keeping track yourself with regards to your share certificates, sort of as and when they're bought and sold, and the proceeds as you go. It gets even more confusing when you're buying and selling shares in the same company, as you can imagine, because then we have to start average costing and we have to start using matching rules, which I'll probably come on to a little bit later.
Right. Okay. Yeah. And it's up to you to declare. It's a self-assessment, isn't it? It's a self-declared tax.
That's right. It's done on self-assessment. So effectively, as it stands at the moment, 5th of April year end goes past, and then you've got until the 31st of January the following year to file that self-assessment, declare the income, and pay the tax on it.
Okay. Mm-hmm.
So obviously with your accounting head on, Tom, how do you reduce my, it was about £6,000, I think it was, or 6,700 as a basic rate payer, or 13.5 grand as a high?
That's right.
A high bracket. How do I?
There's a few very basic things that you could have considered beforehand. And again, this is why it's worth just, sitting down and having a look through your options, probably before you start investing, or at least partway through the year, to make sure that you're utilizing everything that's available for you. So the example that we just talked about was somebody that had invested just using a standard investment account. You can also invest in different ways. So for example, an ISA, an individual savings account. You can put £20,000 a year into your ISA, into a stocks and shares ISA, for example, which obviously allows you to direct what you invest in. AIM shares, obviously, we recently admitted into ISAs so that you can now trade in AIM shares as well. So you could have put that £20,000 into an ISA. With the same result, with 100,000, with proceeds of £100,000, there would have been no capital gains tax, because an ISA is a separate wrapper. So any gains that are made within an ISA aren't subject to CGT.
Yeah, and you can trade within that ISA as well, as long as you don't withdraw. That's the key.
Yeah, you can keep trading within that ISA, building your gains up and compounding from there. The only limitations you've got, obviously, one is you can only put £20,000 of your own money in there within the year. And then there are certain exemptions with ISAs, things that you can't trade in. So, for example, warrants, options, things like that.
Mm-hmm. And obviously, you could, if your wife is working, or your partner, or whatever, and paying tax, you can also utilise their ISA as well.
Allowance. Some ISA providers will allow you to trade on their behalf. You'd have to get signed authority to do that. But yeah, effectively, you can utilise your wife's ISA allowance too. So effectively, you've gone from 20,000 to 40,000 allowance a year that you can keep in a tax-free wrapper. The other benefit of ISAs as well is any dividend income. So, I mean, moving away from junior AIM stocks and into perhaps dividend payers, but any dividend income that comes into those ISAs isn't taxable either.
So it's all tax-free. So let's say you do make that X amount of money, your ISA suddenly is worth that much more. But you're not, and you can just you can keep reinvesting that, as you say, and compound that, and it continues to be tax-free.
It continues to be tax-free. If you're lucky enough to put, say, 20,000 in on the 6th of April, and then let's say something goes ballistic and you've made 100,000 6 months in, you can still keep trading that same 100,000 in the same tax year, because you've still only put 20,000 of your own cash in.
Of your own cash.
Yeah, absolutely.
So really, it's a no-brainer to have an ISA then, really, as a trading ISA.
A trading ISA is would always probably be the first port of call for certainly retail investors and investors that are just coming into the market. Mm-hmm. So yeah, definitely a good option there. Yeah,
the kids can get involved in that as well, can't they? I'm sure I've read somewhere along the line.
Kids can get involved in ISAs too. There's a children's ISA limit, which off the top of my head is about 3,000-ish actually. Children's ISA limit is, but yeah, it's about £3,000-ish. So yeah, your kids can get involved in that. There's other types of ISAs as well, but obviously you've only got £20,000 across all the different types of ISAs to invest in. So one's an innovative finance ISA, which is like peer-to-peer lending, but there's and the lifetime ISA as well. So there's different options within ISAs, but purely for stocks and shares and for trading, the stocks and shares ISA is 100% the way to go.
So say you're fortunate enough to have more than 20,000 then, Tom, what other options are open?
So the next thing you might be looking at is a self-invested personal pension, or a SIP. This has got quite a lot of benefits to it. The big one being is the fact that if you pay money into a SIP, then what you're going to get is you're going to get some government relief on that money as well, which is actually going to increase the value of your investment before you even do any trading. So, for example, for every 80p that you put into your SIP provider will claim the relief back from the government, and that 80p will actually go in as £1. So you're effectively getting a 20% uplift on what you're putting into that SIP. If you're a higher rate payer, then you can also then claim back another 20p. So at the end of the year on your self-assessment return. So effectively, you're paying 60p in and getting £1 out for each unit that you're investing through your SIP. And that allows you to trade in the same way as a stocks and shares ISA, or a lot of SIP providers will allow you to do that. So you're picking your own investments. But there are a few drawbacks to it, and there's a few other bits and pieces that you probably need to be aware of. The main one being, obviously, if you're building money up in a SIP, you can't actually access that money in the same way you can an ISA. You've got to leave that money in the SIP until you're at least 55. And 55 is the current age. And with the way that pensions move, that could change. They could increase the age limit on SIPs as time goes on. So it might be that by the time you come to retirement, they might have raised the age limit to 60. So you've got to be prepared to lock the money away and not have the access to it for other things. But it is quite a useful way of building money up. The other limit is that you've got is that you can pay 100% of your earnings into a SIP in a year up to £40,000. So you can pay, basically, you can't pay more than £40,000 into your SIP in pension contributions in a year. And this does taper down a little bit as well, the more that you earn. Once you start earning more than £150,000, that £40,000 limit actually starts coming down.
Okay, so say you're a youngster and you don't really want to lock your money in, for the next 35 years or whatever. Any other?
Well, just on the SIP, just before we move off the SIP, just if you take the SIP and the ISA together, if you take the £40,000 SIP allowance, provided that you're earning enough money, and you take your ISA, then you've got £60,000 there that you can put in tax-free wrappers that you can trade with to accumulate wealth. And if you're lucky enough to be married, then obviously you can do that twice over. So that's £120,000. So there's plenty there within those two. In terms of other tax-free options with investments, your next port of call is probably a little bit riskier, but spread betting, for example, there is no capital gains tax on spread betting. Because if you think about spread betting, what you're doing is you are taking a position rather than actually owning the stock in the company. So they can't tax that as capital income. It's taxed in the same way that gambling's taxed, for example.
Yeah. Mm.
So that's
it's the same as Forex. I've got some money in Forex, and there's no tax in that either. So. That's right. Because you're not actually owning you don't actually own the asset, or you don't actually own the stock in there. You're just literally trading on the margin. Yeah.
So
a game of chance. I think that's how they describe it, almost.
Absolutely. So then beyond that, what you're really starting to get into is looking at ways to perhaps utilize your tax-free allowance in a year by rebasing your share costs. And this is when it does start to get a little bit complicated. Because if you've got money in standard investment accounts, or if you've not got it in the tax-free wrappers, but you want to start being a little bit more efficient with it on an annual basis, then you might want to look at different options that you've got to utilize your annual capital gains tax allowance. So again, just to recap, everybody gets £12,300 at the moment of capital gains that they can make without paying any tax on. That's the starting rate of your personal allowance for capital gains. That allowance doesn't roll over. So if you don't use your capital allowance, if you don't use your capital gains tax allowance this year, you can't roll it over and have twice as much next year. So if you don't use it 12,300 this year, it's gone forever. Mm-hmm. One thing that people used to do back in the olden days was a practice called bed and breakfasting. So I don't know if you're familiar with this or not, but bed and breakfasting basically was the practice of raising the base cost of your shares such that you are reducing the long-term capital gains implications. The way that you would do that is that you would sell enough shares sort of on the last day of the tax year just to make enough gain that you are under your capital gains tax allowance. So you'd say you've got £6,000 worth of shares at £1 each, and then the value of those shares had risen to £18,000 in the year, so at £3 each. So you would sell the shares for £18,000, take away the £6,000, your gain would be £12,000. So you're under the CGT limit, but you still want to own those shares. So you would sell them on the last day of the tax year, and then you would buy them back the following day to try and minimize the, any potential price fluctuation. So you bought them on the first day of the new tax year. So you still own the same shares that you owned before, but now those shares are valued at £3 each rather than £1 each, because you've transacted the old shares out and then you've bought the new shares in at the higher value.
Mm-hmm.
Does that make sense?
Yes.
Yeah.
Yep.
Yes, it
So
does.
that now is, the HMRC were wise to this. They realized that people were raising the base cost of shares this way, so that ultimately, those shares that were £1 and now are £3. So when you come and sell them further down the line, you've managed to utilize your capital gains tax allowance for that year. Mm-hmm. So what they did was introduce share matching rules, which basically, this is the 30-day rule that I'm sure you've heard of. So what they now do, the way that they value the shares that you've sold, is they apply an order to the shares that you've sold. So if you sell those shares on the last day of the tax year, then HMRC matches those shares against, first of all, any shares bought on the same day. And then they match them against any shares that you've bought 30 days after you've sold them. So effectively, it nullifies that gain. So they would take the £3 value and the £3 gain, and you've not actually done anything. And the base cost of the old share stays in there at £1. So you can't do that anymore. However, there are methods that are very similar to that allow you to move shares out and rebase cost. One would be Bed and ISA. So you can actually sell your shares on the last day of the tax year and then rebuy them the following day in an ISA. And that doesn't break any of the 30-day rules, because an ISA is classed as a completely separate tax wrapper. So that's one way of getting shares out of an investment account into an ISA without the capital gains tax, provided you're staying within that capital gains tax limit of 12,300. So it might take you a few years to move it across, and provided you've got your ISA allowance, of course, still available. So that would be one option. Another option would be Bed and SIP. So again, same practice, exactly the same. A SIP is a separate tax wrapper to you individually. So again, sell them on the last day, rebuy them in the SIP. And then another one is Bed and Spouse. So technically what you could do is sell them on the last day and your spouse could buy them the following day in her name. Obviously, if you're doing that, she takes control of the asset. HMRC, we've not seen it. HMRC might have a little look at that for anti-avoidance. Again, it's not there. It's not written that they can do that. There's nothing to say that your spouse, she's free to buy whatever shares she would like to. But Bed and Spouse is another way of doing it. And then another one would be Bed and CFD. So this is slightly different, because what you're actually doing is you're going to sell the shares on the last day of the tax year. So you realize that gain, you utilize your allowance, but then rather than buying them back the next day, what you do is you take out a CFD, a contract for difference, and you hold that for 30 days. And that protects you against any price movement in that share. So if you sell them and then the price rockets up, then obviously you're going to make a gain on the CFD. So when you close your CFD in 30 days time, you can then go back, use the increased proceeds or decrease if you've made a loss, and rebuy those shares. So you've been protected, you've hedged against any price movement using a CFD for 30 days, and then you're back in for the same shares at the higher cost. You've rebased your initial share cost.
Yeah, okay, it makes sense. It's a bit nuts, but you've explained that quite well. I'm wondering, I've heard of Bed and ISA, Bed and SIP, and they are things you can do. It actually says that on your yes. online broker account. I've never heard of Bed and Spouse. Is that actually something you can click to do, or is it not as simple as that?
It's something that is done. On the subject of spouses, there's a few things to sort of know about it for capital gains tax. First of all, you are entitled to gift the proceeds or gift assets to your spouse. So if you gift your spouse assets, there's no capital gains tax on that transfer. So if you've got, I don't know, let's say £20,000 worth of shares and the value's 100,000, you can actually turn around and give 50,000 to your spouse before the tax year end, hold 50,000 yourself, and then if the intention is to sell them, then at least what you're getting is you're going to get 2 lots of capital gains tax allowance. So you're going to get 2 lots of 12,300 to come off there. And that's fine. There's nothing wrong with that. You are legally allowed to transfer assets to your spouse. Mm-hmm. And so the same technically would apply to Bed and Spouse, so to speak, whereby you could sell the shares and then your spouse could rebuy them. Like I say, I've seen it done before. HMRC, I still think it sails a little close with HMRC for looking at anti-avoidance. But then when you go through the manuals, there is actually nothing there to say that you can't do that.
But it must be something you have to do manually then.
What the actual
selling and buying? I guess it's not something you can just go on your online broker account and click bed and spouse. I guess it's something.
Oh no. Actually, so it's a manual process. Your wife would need the broker account. She would need to go and buy a share.
Yeah.
And obviously, you do run the risk. That isn't suitable for everybody. It's not suitable for all marriages, because at the end of the day, the spouse controls the asset. Then that isn't your asset. It is the asset. What you wouldn't want, and what HMRC would certainly would take up, is if the spouse buys those shares back. What I think HMRC would look at for anti-avoidance is if she then gifted the same shares back to you at a later date.
Yeah, you can actually see those trades sometimes, Mark, in some of the shares. It's usually two trades, say 1 million shares or whatever, doesn't matter what amount of shares, and they're straight after each other within about a minute, and there's usually about a micro percent difference between them, and they're usually at the top of the right at the top of the ask or the bottom of the bid, and that's usually what it is. It's a bid and ISA going on, and you can always tell by the value as well. It's kind of giveaway.
Yeah, that's the difference. Certainly with AIM stocks as well, when the price is so sensitive and can move, on a hair trigger, you don't want to be out of the market. If you want to retain those shares, then you've got to have something in place in order to make sure that you're not leaving yourself exposed to that price movement.
So, and a HMRC, are they like actively? How would they become aware of something? Are they actively looking into it, or do you have an idea how they will become aware that you were trying to do something dodgy?
I don't know about dodgy. There's lots of ways that they've got these days, and I mean they've got increasing powers. And I think, I spoke earlier that they've just ordered a review of capital gains tax, which is why this becomes even more important now. So what they're going to look at, especially with the hole that we've got in COVID funding, with all the different schemes that we've had, capital gains tax is actually, I think 2018 we raised about £8 billion in capital gains tax, which on the total capital gains for the year, I think it works out about 15% on the total capital gain of the year. So when you bear in mind that most people that are paying capital gains tax are higher rate taxpayers, 15% as a tax burden, they've identified as being potentially we've got room to move this up. So they're looking at reviewing capital gains tax at the moment, and I think there's a few things they're going to look into. Increased powers in terms of looking at bank accounts, looking at share transactions, things like that. Right. I mean, people that are dealing with brokers and things, it's a very easy step for them to start going into broker accounts. And then I think what they're probably going to start looking at is potentially doing away with the annual capital gains allowance, or if not, then the other sort of talk at the moment is of them potentially raising capital gains tax. So where we've got, say, 10% basic rate and 20% higher rate, they might look to equalize that or bring it closer to parity with income tax, so that you'll have 20% basic rate and 40% higher rate. So it really does become important to sort of have a good assess of your capital gains tax position.
Yeah, I mean, and of course, we're in no way here encouraging tax avoidance at all. I was just wondering, what I guess they have ways and means, to find out if you're doing something.
Yeah. You bring up a good point though, Mark. I mean, I'm sure that there's people out there that have just probably buried their head in the sand. They've probably made a shed load of money in the last couple of years. And they're sitting thinking 2 years has went by in a flash, and I've not filled in a single form, or I've not declared. And so where do these people stand? I mean, there's anything they can do retrospectively, Tom, to sort of get back in HMRC's good books?
Yeah, absolutely. I mean, the first port of call is to go and get some professional advice straight away if you find yourself in that position. You've got to have a little, work through the gains, work out the gains for each tax year, submit retrospective self-assessments. HMRC generally are good to deal with on things like this, but you've got to be upfront with them. And it's better to go to HMRC than for HMRC to come and find you, without a shadow of a doubt. HMRC work on a basis of sliding scale penalties. So anything from 15% to 100% of the tax owed. So it's very possible, if you've racked up a tax bill of 25, 30,000, say, for example, in capital gains tax, and then HMRC come and have a look, and HMRC have found that, they've asked you the questions, and they take the view that you've deliberately concealed it, for example, they can actually charge you 100% penalty on that tax. So you might end up paying £60,000, for example. So it's very important that, you know, if you think you might have missed something, and there are genuine reasons for it. And to be honest, a lot of people that are investing are people that are effectively employed in their everyday life. And so they've never really had much experience with the self-assessment system and never had any cause to, because the pay-as-you-earn's always been taken care of. So it's very important to sort of come forward as soon as you can and try and work out exactly where the land lies.
I mean, that is the point I was going to come on to. What if it is someone who is just, as you might say, a retail investor who has say an ordinary job, PAYE, but just fancies a bit of investing and has done quite well. What is their port of call then to find an accountant such as yourself, I guess?
Absolutely. Take some professional advice, find an accountant, and sort of try and work out where the land lies as you currently stand. Like I say, I mean, there's lots of offsets. There's bits and pieces in there. You know, you still get the same capital gains tax allowances. You're still taxed at the same rates. You can still offset your losses. So it's a case of just getting somebody to sit down and work out exactly what you do owe, or what you might owe, and then take it from there, and then, you know, prepare the necessary paperwork, submit to HMRC, and away you go.
And an accountant, so are they expensive, or does it depend what kind of service you go for?
The accountants are all different. They'll all charge different rates. I think we find, based where we are, sometimes we do a lot in the city. We do a lot with professional footballers as well. We've got a lot of different client bases that work in you know, what we call personal tax returns that we do. And I still don't see it as particularly an expensive service. You know, self-assessment preparation certainly generally, you know, won't cost a great deal of money in terms of what you might save.
Yeah, I mean, I think for my business, Mark, I pay £108 a month, including VAT, but I enter all my own data. I mean, I put all the spreadsheets together that they send me, and I do all that myself, albeit I'm 10 months behind at the moment, but that's just typically me. I dare say you can get, if you're too busy to do your own books, you can probably pay for a junior. You just submit your banking statements every month and your invoices, and they'll do it all for you. But at the moment, I'm just doing it myself.
It's a sliding scale thing. I mean, it depends on what sort of setup you've got. So if you've got somebody who's perhaps otherwise employed and just needing self-assessment doing, then you know, that's not going to be, you know, that might be a few £100. And then, you know, you do ramp up a little bit more as you're going into actual sort of SMEs and businesses, so sole traders, partnerships, limited companies, that sort of thing. And then, you know, the fees start adding up, but it's how much you want out of it at the end of the day, and you know, what you expect out, you know, from the other end. But yeah, it's certainly for retail investors, it's not something that's cost prohibitive.
Okay.
Yeah, definitely. Yeah. One thing we haven't touched on, Tom, is what about losses then? So say you have a horrific year, you know, you know, some people have been smashed this year or last tax year. Although it kind of rolled over, didn't it, COVID, into the last tax year and this tax year. So regardless, say you have a really crap year and you've got a 50k loss.
Yep. Again, as long as those losses are crystallized, so unless you've, you know, as long as you've actually sort of sold those shares and you've got a 50k loss sort of sitting there now on your books, so you're not holding the actual asset anymore, shares have gone, then you can use that loss. So you can either offset it against gains in the current tax year if you've got other gains in that tax year, or those losses will carry forward. You can carry them forward and offset.
How many years can you carry them forward?
Indefinitely. They'll sit there until they're gone.
All right, okay. And that's just for personal CGT?
That's for CGT, yeah. You can't offset your income tax.
Yeah, all right, okay. No, I just wasn't 100% sure about that rule, but I'm sure, again, there's people out there that are probably in that situation as well. So, yeah, it's an interesting subject. And I suppose when you come on to, like, obviously, most of the shares I own are actually my business name, which is a completely different ball game as well. There's a completely different set of rules.
Yeah, completely. If we're talking limited company tax, I could fill probably another sort of 4 hours on that. So
yeah. We'll save that for another podcast. But no, it's worth talking about, because there's plenty of guys out there as well that will have their own limited company, and it's good to know both sides of the scale, so to speak. But No, it's one of these topics that just doesn't go away, and there is a fear about it. I mean, I've talked to you. You're a nice guy, but see, for me to pick up the phone and speak to my accountant, it fills me with fear. It's like going to the dentist. I don't know what it is. I don't know.
I was going to touch on that earlier. The number of clients, and I mean, there's guys that I'll see, I've probably been seeing sort of 10, 15 years, year in, year out. And they still come in and they're still like, it still feels like coming to the dentist, coming here. And it's there is a fear to it. And I do understand it, because obviously you think it might end up being painful if there's money owed. And nobody likes to think they've perhaps done anything wrong either. Most, 99% of people have the best intentions. And they don't like to think they've perhaps made a misstep, but it's really not something to be afraid of. And a good accountant will be able to put you at ease and ideally save you a bit of money as well. Yeah,
definitely. So do you have what is your kind of client base then, Tom? Just sort of stepping back from the CGT side of things, what kind of split is it?
The majority of the work that we do is SME, sort of limited company based, small limited companies. So anything up to sort of 6, 7, 8 million pound turnover. We've got a very wide spread of that, and I think, funnily enough, we were going through the figures last week. I think 75% of our client base now fall into that category. What we are seeing, we've got a few sole traders and partnerships as well, but we are seeing a big increase in personal tax clients. So within that, that's people that might be employed, that have other assets. So again, doing a bit of trading, for example, or have land and property. So they've got rental income coming in. A few people that are retired and have different investments that are income generating. And that side of things is really taking off. We deal with quite a few, like I think I mentioned earlier, professional footballers that's just gradually sort of referred on. And it's good work. It's interesting work. And then we get involved in all sorts of things. We do forensic accounting, for example. We do a lot of business recovery and turnaround, or my father does through his advisory with a insolvency practitioner. So yeah, we've got many strings to the bow.
So I assume that any good accountant, Tom, then if somebody picks up the phone and wants a chat with you, there's no cost. You're quite happy to talk to people and give them a bit of advice.
Yeah, quite right. We'll talk to anybody that needs a bit of advice and needs a bit of help. I think what we'll be doing is putting some notes around what we've talked about today up on our website as well, just for people to click and have a little look through, because it's quite a lot to take in when somebody's sort of talking at you over a podcast, I imagine, CGT. So yeah, it's just a good idea just to have a look on there too.
Do you want to have a plug for your website, Tom? While we're talking about websites.
Thank you very much. It's www.greenlineaccountants.com. We keep it fairly up to date with news and developments on there as well, especially during COVID. So a lot of the COVID updates have been on there very regularly.
Perfect. And I suppose the question for me is, can we get you back on so we can talk about limited company tax as well? It'd be good to hear. I should really phone one accountant, but this seems like an easier format to ask questions.
Yeah, absolutely, no problem at all. I'm happy to come on anytime. Obviously, the standard caveat applies to everything on here, whereby you need to talk to a professional before taking up any of the advice we've talked about first. But because there's no one size fits all approach to tax.
Perfect. Mark, you get anything to add before we finish up? Because that's about 40 minutes. That's a good time.
It is a good time. I mean, I did want to ask you, Tom, because you do sound like you know a lot about. You talked about AIM quite a lot. Do you do any private investing yourself?
I used to, and to be honest, I've found myself sort of gradually over the last couple of years moving away from AIM and or sort of certainly away from the junior stuff and more into sort of FTSE all-share stuff. But yeah, I do a little bit myself. Yeah.
Okay. Well, maybe we can talk about that on another podcast, maybe. But that was good. A nice little summary there and of CGT and some of the options. It was good. Thank you.
No, thanks for having me.
Not a problem. Right. Well, thanks for the time, Tom, and we'll get you back on and we'll talk about business tax. Everybody's second favourite subject.
Look forward to it.
Thanks, anyway.
Thanks, Tom. Thank you for your time. Yep. Bye-bye. Thank you for listening to another podcast from Market Musings with Fairbairn and Russell.